In the constantly changing world of fundability, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. Welcome to the Get Fundable podcast with your host, Merrill Chandler.
Welcome back, everybody. Merrill Chandler, your host of the Get Fundable podcast. I am so excited because finally it's here. We're going to be talking about FICO 10, the newest version of the FICO approval funding or funding approval software and all the things that come with it. So when we come back, we're going to do a deep dive into this absolutely awesome software that really has some great news for us. And for those of you who've been binging all my podcasts, you're even going to see where I've been, the things I've been telling you are ahead of their time. So when we come back, we'll get right to it. Welcome back, everybody. Merrill Chandler here. Okay, let's take a look at this. This is so much fun. I'm telling you right now, FICO 10 is just killing it. So in this episode, we're going to be talking about how FICO 10 impacts you. And as I did my study of all of this, checked in with my FICO liaison, I was actually a little ahead of my time. So we're going to talk about the things that I've been preparing my students and clients in the boot camp. Even what I wrote in the book, were all forecasted to come out in FICO 10. So all the information that I got from FICO, they're talking about the newest version of the software, tightening up all these things. I'll for some of you, I may be just speaking credit geek ease, right? But I'm excited to share this with you. So first things first, the first thing I want to do is I'm going to share my screen and show you a little bit of what we are, the history of FICO and what all the things are that FICO has been releasing over time, right? So let's take a look here. This is the FICO score evolution, and as we evaluate this process, the original scores, what's known as FICO 542, actually had different names back 30 years ago. So the FICO score began being published for consumer, began being used in lender evaluations, right? When in the credit evaluation for lenders back in 1989. And these scores, remember, they've been evaluating borrower behaviors since the 50s, but it got fine-tuned in the late 80s with a formal tested score, right? Then 1991, was when 542 was announced, what we call now 542. Each one of the credit bureaus had their own version of the FICO software, 5 for Equifax, 4 for TransUnion, and 2 was the version that Experian used. So we call it 542 because all 3 bureaus were using their very customized FICO algorithm for their data. But in 1993, FICO came out with all of this. FICO came out with taking a look at this. FICO came out with the what do you call it? The industry specific scores, right? Sometimes I refer to them as vertical scores because they're vertical markets, but there's scores for auto loans, for credit cards like bank card scores, not retail, but bank card scores, and for a mortgage and small business lending. Now, small business lending, we've come to know as the small business scoring service. But these four vertical markets, small business, mortgage, auto loans, and bank cards, are all started in early 90s, right? 1993. Then 95, Fannie Mae and Freddie Mac started using the FICO scores to evaluate the residential mortgages. And each one of these verticals, each one of these industry specific scores have entire divisions at FICO where they're building based on the specific data for those scores. Be sure and read my book. Come to my boot camp. It's Get Fundable book.com, getfundableBootcamp.com. So you can find out. We go through all of these in a huge, massive, deep dive on how to explore and how to use these different scores for your fundability. Well, 2001, of course, FICO launched myfico.com, and that's where we recommend, if you want the truth about your fundability, the truth about your credit score, where you can get a copy of your mortgage scores without going to a mortgage broker, copy of your auto dealer scores without going to an auto dealer, copy of your bank card scores. All your credit scores are evaluated based on these verticals. They're at myfico.com. Get those reports. I don't recommend anything else because, as I always tell you, only the truth is actionable. And we want to make sure that we can make proper and deliberate choices, and we need the facts to do so. So 2001, MyFICO came out and really empowered us. It was able to give borrowers the tools they need to see how they're doing, right? 2004, they started offering FICO scores in other countries. 2007, they put here the 100 billionth FICO score was sold. I mean, those are definitely milestones, right? Then 2009, literally 11 years ago, FICO Score 8 was introduced. FICO Score 8 is what's commonly used right now. In fact, if you read in my book, I talk about, and the boot camp, we talk about FICO Score 8. That's the unweighted score is the one that's used more than any other score used by lenders. And it's your account valuations, when they do a soft pull, all those types of things are FICO Score 8. So it was established in 2009, and it's a big deal. It's still the highest installed base right now. Then FICO's the FICO started using what's called the economic impact index so that they could see more and more. And that's some of the data that's being used for what I've recently been speaking about of the FSSI score. They're not the same. The economic impact index is not the FICO score stress indicator, the FSSI. That's a new release, or the thing that they're still working on, and has an integral relationship with FICO 10. Then 12, they announced scores for the Spanish market and the Hispanic, the Spanish speaking language market. And then 2013, there's what's called the open access. Now, open access is this free access, when you go to your credit card issuer or some of your insurance companies will say, hey, get a copy of your FICO score. That FICO score is what's called the open access. You'll read about it, learn about it in a number of different areas, but 30-second review. Open access is they get to, if they use FICO Score 8, for example, if they use FICO Score 8 to establish a credit limit increase or to review your file, it's called an account review. If they use that, then FICO in 2013 basically said, hey, you know what? You've already bought this score so that you can use it for to evaluate how well your credit card holder is doing. I'll tell you what, we'll let you tell them that score. So it's not your auto score, it's not your mortgage score, it's not the score that's being used to evaluate you for bank card and big ticket purchases. It's the review score. Think of that FICO 8 unweighted score as a review score. They start in 2013. They started allowing banks and credit card issuers to give you the score that they already purchased. So that's, and again, my the book of the boot camp do deep dives into this, just so you can not just know these cute little facts, but how it impacts your fundability, how it impacts your funding approvals, because knowing the rules of this game is a freaking home run. All right, so 2014 FICO Score 9 was launched in 2014. Here's what's fascinating. FICO Score 9 was where they basically removed any paid or unpaid collection was not counted against your score, and any medical collection, paid or unpaid, was not counted against your score. So anything under $100, the $32 cell phone bill, whether it was paid or unpaid, if it was under $100, FICO 9 didn't count it. If it was a FICO, and if it was a medical of any amount, paid or unpaid, it didn't count it. So that was historical. Well, now we're even in a more significant, because here we are, 2020, 6 years later. They have announced a couple months ago that FICO 10 would be released this summer. So I'm going to stop sharing this and let's take a look at what we're at where that goes. All right. So let's next. So there's kind of the history, the review of all of this. So what is FICO Score 10? I have the actual the release paperwork that I received from my FICO liaison about some of the big deals. So I'm going to quote the actual product sheet for FICO 10 to kind of give you an outline. Now, there's FICO Score 10 Suite. Suite means you're going to get the unweighted score, like we talked about, that lenders can provide you. They're also giving you access to the auto score, the mortgage score, the bank card score, and the auxiliary business credit score. All of those are what's called the suite. So FICO Score Suite. Then there's also FICO 10T. We'll get to that in a minute, but I'm telling you, FICO, it trended data. And this is where my, I don't know why this stuff turns me on, but this is my jam. And I'm going to show you some things we just nailed. Here's one of the things that, and I'm going to read this directly from the product sheet, but it says that lenders who use FICO 10, are going to have a significant reduction in defaults. Here's exactly what it says. There is a lender could reduce the number of defaults in their portfolio by as much as 10% among bank cards. So that means that the predictive power of FICO 10, lenders will lose 10% less to default from this process. 17% for mortgage loans. So it'll predict using this will predict the lenders will save 17% more from losses due to defaulting mortgagors. And then it even says that among auto loans, it's 9% among auto loans, 10% of bank cards, 9% auto loans, and 17% fewer defaults on mortgages. These numbers are incredible. This is in one version improvement from FICO. So let's go over some of the big pieces of what this means, and I'm going to talk about trended data. All right, now FICO 10 talks about trended data for the first time. Now, I have built the entire fundability optimization is built on trended data. We call it the 24-month look-back period. Now, FICO doesn't call it a look-back period, but if you read anything about FICO 10, it uses trended data, sometimes called time series data, that how you've managed your accounts over the previous 24 months. What? How is that? We've been coaching our people to coaching you even here, podcast, book, and the boot camps on exactly how to manage your previous 24 months so that you can be more fundable, right? You can take down more funding approvals. So they look at how you've managed over the last 24 months, and they're actually distinguishing now between revolvers and transactors. So they call lenders, they call borrowers who charge up the let's say put 10 grand on your credit card and then pay it to zero on the due date. Those are called transactors. Revolvers are individuals who carry a balance and then make a smaller payment or a minimum payment on that balance. So though the score in everything that I've ever learned before, they didn't score those things. It was always based on the balance. So now they are differentiating those who pay it all the way down. But you got to understand, we've talked about this. Those of you who are listening from my boot camps and clients, they're still not revealing to the world about the reporting date and how to carry the perfect balances at the reporting date. So more on that later. But consumers who pay their credit cards in full are considered lower risk than those who carry balances, right? That makes sense. But they are now tracking over this, what I call the 24-month look-back period. Over this period, they're now watching the reduction, maintaining, or increasing of your balances. So just like I predicted, just like I've been teaching my clients, the score is now watching all of the movement over the last 24 months. Now, they only talk about 24 months here. I'm telling you from the work, the research that we've done, the subtle answers we've been given from our people at FICO, what they're told us in private, they have not said publicly, but these periods in the 24 months are 3 months, 6 months, 12 months, and 24 months, and they have significant impact over your score. So how you reduce or maintain or increase your balances is being measured. We've been coaching on this, but I'm telling you, now they're coming out in full force and telling everybody what they're doing. So this is awesome for our borrower education efforts. Next, delinquencies will hurt your score more under FICO 10. So if you go, a delinquency is a 30-day late, 60, 90. If you go 30 days late, it's going to hit you harder than it did in FICO 9, FICO 8, or FICO 542. So any delinquency has more immediate impact against your score and your fundability. And it's going to last, just so you know, those last a minimum of 20. After 24 months, you get back some of the credit score points from a delinquency. And after 48 months, another 24-month look-back period, you get more of those points. Details are in, we haven't got time here to go through the entire boot camp. That's why I have you go to the boot camp, right? Or read my book. Now, credit card debt will have a bigger impact with FICO 10 as well. So we've always talked about that your personal credit profile, your borrower profile, is the goose that lays the golden eggs. That means the better you take care of your personal profile, it will lay the golden eggs of funding opportunities, both mortgages and cars on your personal side, but over on the business side, you have higher capability of getting funding approvals. So they're actually tracking to a more significant degree the credit card debt, what the pace is, what it is that you're carrying. All right. Then credit card, personal loans may lower your score. Now, remember one of the, we call it debt shifting. I've been loud and proud about this. We're not the only ones that know this, but we are one of the very few outside of the hallowed halls of FICO that know the impact that this has. So a number of times people will go, if they've got credit card debt, they'll go get a personal loan, right? That personal loan could be from a credit union, it could be from a fintech, the financial technology companies, et cetera. And do you use those loans to pay down your revolving debt? Because usually those loans, personal loans, have lower interest than the 18 to 22 or 26% that a credit card would, right? Well, the problem is that right now they're tracking, and once again, you heard it here first. If you get a personal loan and you pay down those credit cards and then you charge on those credit cards and carry a balance, your score is going to take a significant, not a little bit of a hit, a significant hit. So there are strategies on how to use your revolving accounts, your credit cards, after you pay them down. But you got to know how the rules. Again, they're only giving us the little tiny, the iceberg, the tops of the iceberg, the tips of the iceberg. They're not talking about all that stuff that sank the Titanic because it wasn't visible when it got hit. All right. So the personal loans used to pay down credit, and then you charge up you mistakenly, or you don't use your credit cards after that the right way, are going to hit your score significantly. Now, every movement on your profile is going to be, every movement is going to have greater impact. In the bootcamp, we talk about what we call the fundability pyramid, right? And this fundability pyramid creates basically states, again, I can't go through the entire boot camp here, but basically states that if you do an activity, the impact of that activity is different based on where you are on the credit profile. So let's say you get an inquiry. If your scores are in the 600s, that inquiry may take 15 points. If you're in the 700s, it may only count 10 points against you. If you're in the 800s, it may only count 5 points against you. So wherever you are on the fundability pyramid is how much impact. Well, in FICO 10, they're saying that and by the way, the positive, it happens the same way. Yeah, if you do a positive borrower behavior, it has less impact the higher up you go, and the more impact the lower you are on the fundability pyramid. Now, FICO 10 is saying that those movements are going to be even bigger. So if you do let's say you pay down you have a $10,000 credit card and you pay down, I don't know, $5,000, right? And you pay it half off at 50% utilization. You charge it all the way up and you paid half of it back. If you're in the 600s, it's going to have even more powerful of a positive impact. If you're in the 700s and 800s, it'll just have more positive impact compared to previous FICO 9, FICO 8, FICO 542. But it will also, negative behaviors, which includes inquiries, late pays, high balances, negative borrower behaviors are going to strike you down. It literally says the bad gets worse. Okay. So any activity that you're doing, what we call borrower behaviors, any borrower behavior you do, if it's a positive one, you get greater impact. If you do a negative borrower behavior, you got negative borrower, a more significant negative impact against your profile. So guys, this is FICO 10 is phenomenal, and apparently lenders can opt for FICO 10 or FICO 10T, which 10T means all the trending data. And this trending data is the bomb. So recap. This summer, FICO 10 is going to be available to lenders. It's an entire suite of scores. If you want to know more about this, go to the new F word and get my book, The New F Word, at getfundablebook.com. If you want to be able to do a deep dive into 2 days of this level of understanding, and remember, you're not just learning stuff, you're learning that what you do matters across 40 plus borrower behaviors. Come and find out how to use those borrower behaviors to your advantage. And we'll now have a complete section. As soon as they publish it, we'll have a complete section on FICO 10. So my book talks about FICO 10 and how it works. So guys, I'm so excited about this. FICO gets tighter. The more predictive they get, the more power we have over our funding approvals. Do you realize that? Because if you know what they're measuring, and you know if you know what they're measuring, and if you know what they're looking for in their funding guidelines, all we have to do is behave to fit the funding guidelines, and you're in charge of your approvals. So I love that it's getting more predictive, and I love that we know exactly what those borrower behaviors are and how to hit your funding. Now, remember, in this COVID-19 craziness that we're all going through here, and the attending kind of craziness of the markets and some sort of recession or everybody's talking about, this is the time to know the rules of the funding game so that you can know the strategies to survive as a business and as a family, your funding survival, right? Then we can show you how to protect your business and do what we call the slingshot effect and create so that it thrives, so that you literally can launch into the next phase after this few months, 6 months, year, whatever it is, 2 years. I don't think it's going to go that long, but what do I know? I just know how to predict. What FICO is going to measure in their next software release. So this is Merrill Chandler. Thank you for joining me. You guys are amazing. Keep binging. Binge everything we've got, every single podcast we've got, binge every single Facebook Live. Join us. Be a part of this community so that you know exactly what time it is and how FICO is going to really, truly transform your life and show you how to get funded. It's been a pleasure. Have a wonderful rest of your day.
Thank you for listening to the Get Fundable podcast. Please leave comments because Merrill would love to read about your aha moments from this episode. And be sure to visit getfundable.com to read our blog, get important links, join our community, and much, much more, like ordering Merrill's tell-all book that is changing the world, The New F Word. And you got to tell your friends about this podcast because we want them to get fundable too.